Before this video ends, I am going to show you something that will make you question everything you thought you knew about how the American financial system actually works. But I need to take you through it level by level, because if I showed you the end first, you would not believe it. So stay with me, because every single level of this video is going to be harder to believe than the one before it. Jake makes $38,000 a year. He gets his paycheck and immediately 6.2% disappears for Social Security, 1.45% for Medicare, then federal income tax, then state income tax. By the time Jake sees his money, roughly 28% of what he earned is already gone. Before he bought groceries, before he paid rent, before he made a single financial decision of his own. This is level 1, the individual worker, paying the maximum rate on every dollar of labor before touching any of it. Now, let us look at what the government takes from a corporation at the exact same moment. In 2018, Amazon reported $14.1 billion in profit, $14.1 billion, and paid $0 in federal income tax. Not a reduced rate, not a low rate, zero. The individual worker paid 28% on $38,000. The corporation paid 0% on $14 billion. Jake looks at his paycheck and wonders where his money went. Jeff Bezos looks at Amazon's tax bill and calls it good tax planning. This is the system, and we are just getting started. Level 2, the small business owner. Jake starts a side business. He now pays self-employment tax, 15.3% on his business income, on top of his regular income tax. The self-employment tax alone is more than some people's entire tax rate. It exists because when you work for an employer, they pay half your Social Security and Medicare. When you work for yourself, you pay both halves. Meanwhile, a corporation that employs Jake pays the employer half and deducts it as a business expense, reducing their taxable income. Jake pays 15.3% for the privilege of working for himself. The corporation deducts the cost of employing Jake and reduces what they owe. Same system, different rules. Level 3, the homeowner. Jake buys a house. He pays property tax every year. Property tax does not care if the economy is bad. It does not care if Jake lost his job. It does not care if his home value dropped. It is due every year without exception. A large corporation that owns commercial real estate can use depreciation to offset the income that property generates, can defer capital gains when they sell it through a 1031 exchange, and in many cases pays effective property tax rates dramatically lower than individual homeowners because of negotiated assessments and commercial tax incentives that individuals cannot access. Jake pays property tax on the home he lives in. The corporation reduces the tax on the property it profits from. Level 4, the investor. Jake saves enough to start investing. He puts money in the stock market. When his stocks go up and he sells them, he pays capital gains tax, 15 to 20%, depending on his income. This is actually one area where the tax code is relatively fair to individuals. But here's what changes everything. A hedge fund manager, who manages billions of dollars for other people, pays the same capital gains rate on their performance fees, called carried interest, as Jake pays on his investments. The hedge fund manager is not investing their own money. They are being paid to manage someone else's money. That payment is their income, but it is taxed as capital gains, not as ordinary income, which means a person earning $100 million in carried interest pays the same 15 to 20% rate that Jake pays on his $500 stock gain, a provision written into the tax code that has survived every attempt to remove it, because the people who benefit from it have the resources to make sure it survives. Level 5, the crisis. In 2008, the American financial system collapsed. Banks had taken on catastrophic levels of risk, made bets they could not cover, and brought the global economy to the edge of collapse. The government responded with $700 billion in bailout money. The Troubled Asset Relief Program, TARP, the banks that caused the crisis now received government money, restructured, recovered, and within 2 years were reporting record profits again. The homeowners who lost their homes in the same crisis received almost nothing. Some received loan modifications. Many received foreclosure notices. The institutions that created the risk got rescued. The individuals who bore the consequences got a letter. Jake was not yet in the housing market in 2008, but his parents were, and the letter they got was not from the bailout fund. Level 6, the $1 trillion level, at the very top of the American wealth scale. Something happens that most people never learn about in any school. The government does not just tax differently at this level, it actively subsidizes the accumulation of wealth through incentives, deductions, credits, opportunity zones, enterprise zones, carried interest, stepped up basis, and 100 other provisions that require teams of lawyers and accountants to access. A family worth $1 trillion can structure their assets so that when they transfer wealth to the next generation, the capital gains tax that would apply to decades of appreciation simply disappears through something called stepped up basis, meaning the tax liability that accumulated over a lifetime vanishes at death, and the heirs inherit the assets as if they were purchased at today's price, with no tax on the growth that occurred before they inherited. Jake will pay taxes on his small investment gains while he is alive, and estate taxes on what he leaves behind. The trillion-dollar family pays almost nothing on decades of accumulated gains, because their legal team knows about stepped-up basis, and Jake does not. Here's the truth that this video was building toward. The American government does not have one tax system. It has multiple systems operating simultaneously, and which system you are inside is determined almost entirely by your wealth level and your knowledge of the rules. At the bottom, the system extracts the maximum from the minimum. At the top, the system actively facilitates the accumulation of more. This is not a political statement. It is not a left or right argument. It is a factual description of how the tax code is written and who it is written to benefit. Jake did not write these rules, neither did you, but understanding them is the first step toward using them and stopping being used by them. You have been decoded. If this video hit you differently, subscribe to Money Decoder 3004. Every single week, we decode the systems that treat Americans differently based on what they know and what they own, simply, honestly, and clearly. Drop a comment below. Which level made you the most angry? Tell me below. I read every single comment, and I will see you in the next decode.